Okay, good morning everyone from a very cold and icy Johannesburg. Welcome to today's webinar. My name is Fatima Vauda. Our topic today is how to build efficient portfolios using style-based investing. And our speaker is 27/4 Head of Quantitative Strategies, Dr. Daniel Page. Before we start, allow me to take you through a few housekeeping measures. The webinar will end at 11 a.m. We have allocated a total of 15 minutes to take your questions. So if you do have any questions during the presentation, just type them into the question box in your Zoom control panel. I will pick them up on my side and we will try and answer as many of them within the allocated time frame. A recorded version of this webinar, including the slide deck, will be made available within the next 24 hours on our website, 274.com. We would love to hear from you, so please do contact us and please look out for the slide deck. As investment practitioners in the industry, through experience, we can all acknowledge that there is no one-size-fits-all approach to building investment portfolios. However, what we do know is that there are powerful tools available to us to help understand market dynamics so that we can build robust and efficient portfolios which have a high probability of delivering superior nominal and risk-adjusted returns. One such tool is that of style-based analysis. So today we will focus on the practical application of style-based analysis with Dr. Page, who is also a leading academic on the subject. We will look at the role of style analysis in the identification and evaluation of asset managers. This is extremely relevant in the global context where there are thousands of asset managers. So where does one actually start looking for that star manager? Style evaluation can be used as an effective filtering mechanism to narrow the universe of managers and classify them according to their performance signatures. Thereafter, a thorough review and due diligence can be conducted on individual managers identified. As William Sharp once said, I would never say that style analysis is enough. Maybe it's enough to help you pick some funds that you want to look at more carefully. But once you look at style analysis and you decide that the fund is interesting to you, you can go much further. On the domestic front, style analysis helps to identify the DNA of asset manager portfolios and the role that they play within the broader portfolio context. We will then take a look at how completion portfolios can be effectively utilized to control and manage any style risk and ultimately increase expected returns through an optimized allocation of capital. Completion portfolios typically fill the hole left by active managers, ensuring that building blocks are well designed and not over or underexposed to any particular segment of the market. We will demonstrate how completion portfolios can be used to diversify existing concentrated holdings to align the overall portfolio to a chosen benchmark. And lastly, we will cover our standalone multi-factor offering. Individual factors such as quality, momentum, value, size, experience cyclicality in performance. They all have historically performed differently at varying stages of the economic cycle based on their unique underlying drivers. For investors who want to benefit from the potential rewards of factor investing, combining these factors into one strategy may produce more consistent results than investing in single factors. So without further ado, we have a lot to talk about today. We will turn the time over to Dr. Daniel Page, Head of Quantitative Strategies at 27/4 Investment Managers. Welcome, Dr. Dan.
Thank you. Thank you. Okay, so we can get started. So I can't say it better than Fatima did, but what we're going to be dealing with is building efficient portfolios using style-based investing. I'm going to kick right off. And obviously they're the parts. So that's today's agenda, which Fatima did describe. and we can get stuck right in. So just to give you a brief history of style-based investing. This is a very, very simple timeline of the genesis of how style-based investing came about, because everybody talks about style, but I think just going back into the history, I obviously haven't quoted specifically the dates or the specific papers that relate to this, but starting off, Harry Markowitz was credited in 1959 with creating a framework for a basic relationship between risk and return. And what he confirmed was that diversification, the benefit of shares moving not necessarily in tandem, but against each other, or assets moving against each other, is almost a free lunch for investors, because what you can do is you can maximize your return while obviously reducing your overall risk. That led on to the CAPM, which is a model that's used in both corporate finance as well as investment. And that's a single factor model of relating risk, which is market risk, or beta, to the expected return on a share. Following that was Farmer in 1970, seminal paper, where he discussed the efficient market hypothesis, which describes that all information is actually already contained in share prices. And that actually ties nicely back to the CAPM, because what that's saying is if all information is already tied in share prices, the only thing that can really judge or determine what your expected return will be over the long term in the future would be the underlying risk. A big issue with the CAPM is that the CAPM only uses a single factor of risk. Ross came about and created something called the APT, or arbitrage pricing theory, where he said you can actually use a multi-factor approach. Now, what happened thereafter, this isn't necessarily the first paper that tests the CAPM, but this here, Farm and French, right? They found that, well, it wasn't necessarily them that found size and value, but they said that when you actually sort portfolios in size and value, the CAPM beta doesn't work. So there are styles that can actually determine future returns. And those styles, it's hard to articulate them in a form of risk. Then you had momentum, which was by Jagadish and Titman, 1993. They also did a paper in 2001, where they found that a style, momentum, which is investing in previous winners and selling previous losers, outperforms the market and also cannot be explained by the CAPM beta. Then we go on to the other styles that have been identified, which was low volatility anomaly, and that's by Baker, Bradley, and Virgo, where they found that completely turning Markowitz's portfolio theory and the CAPM on its head, if you invest in shares that have low risk or low achieved risk, they actually tend to outperform in the future. So that kind of throws a span in the works for the whole risk-return relationship. Novi Marx is credited with one of the first papers on quality, where he said that companies can be actually potentially expensive because you generate high free cash flow and have low levels of leverage. So that's a typical quality company. And those guys, if you invest in them through time, you actually will generate a large premium over junk shares. And then probably the biggest blight against the CAPM was the low beta anomaly of Frazzini and Peterson, where they looked specifically at differently, it's the low volatility anomaly. Low volatility anomaly is literally the share's idiosyncratic risk or total volatility. This looks at the CAPM beta, and they found that low CAPM beta or low market beta shares actually outperform high beta shares on the market. And this gives us a framework of how styles. So all of these styles effectively say that it's very difficult to try capture the return or the expected return of an underlying instrument, let's talk about equity now, using a single risk model. And all of these say that beta doesn't capture that risk. Maybe it's a whole bunch of factors that can explain returns. So that's what style, or the genealogy, or literally the lineage, or this is almost the linear framework of how style has come about and where we are today. Let's talk about the styles that we consider. So you'll see that all the styles that we just described previously, we look at those styles. So we look at momentum, which is literally shares where we would sort shares based on their recent positive performance. Shares that have high positive performance are considered winners, i.e. momentum shares. Low relative recent performance, those would be losers. Growth, which is also considered the inverse of value, shares that are relatively expensive in comparison to peers. Value would be shares that are relatively cheap in comparison to peers. Quality, and we have a multi-dimensional method of defining quality where we look at the profitability side. So you'd look at margin, ROE, ROA. That's the one side of quality. The other side of quality is companies that are relatively strong in terms of their balance sheets, i.e., do they have low leverage ratios? The level of cash flow that they generate or their asset base, is it significantly greater than the debt that they have on their balance sheets? And then we have the last one, which is low risk. And low risk, we can actually divvy up into low absolute volatility or low beta. So these are effectively the styles that we consider. And these are the styles that we apply or research globally, as well as on the JSE. So obviously the main alpha generator in anyone's portfolio in South Africa, just by the nature of Reg 28, would be SA equity. So let's talk about SA equity and style. Style performance in South Africa is an interesting phenomenon, and it's a unique phenomenon compared to, say, the likes of looking at style globally, because styles are a bit more difficult to determine on the JSE because we'd have a relatively smaller bourse. There's a much lower number of shares on the JSE compared to all the indices that are available in the US. It is relatively liquid, i.e. we are limited to, say, probably the top 120 shares, because if you have a large portfolio or portfolio in excess of R1 billion, you actually will end up moving the market if you're investing in low liquid shares. That's a big issue. Then another thing about the JSE that's very important to be cognizant of is that it's Rand hedge heavy. So the JSE, the top 40 shares, a lot of them are Rand hedge shares. Therefore, it's not representative of the South African economy. So we have to take that into account when actually dealing with style-based investing on the JSE. So what I've shown in the figure the figure alongside this is style performance over the period 2000 to December 2008, from January 2009 to December 2015, and from January 2016 to April 2020. So what we saw over 2000 to 2008, if we look at all the styles, you'll see there that I also have included the J203 ALSI, which is the JSE ALSI, and obviously T means that it's a total return ALSI. It includes dividends and any other corporate actions that can impact returns. And you can see that all of our styles, so momentum, value, growth, low risk, quality, they all did incredibly well. And the one that was most similar to the JSE was probably growth. If you look at styles from 2009 to 2015, you see a bit of a divergence where from 2009 to 2015, you had a period of time where momentum, growth, and low risk did incredibly well. Value underperformed over that full period. So both value and quality underperformed in that period. But the styles that have done well are low risk, so that's a combination of low beta and low volatility. Quality and momentum has done relatively well. If you look from 2016 onwards, the best performing styles are quality and growth. So what we're seeing is that styles aren't necessarily, over the long term, they should give you a decent amount of performance, but styles do change, they shift. A key takeaway of that is styles are risky. These are risks. If you invest in a style, it's not a magic bullet that's going to immediately make everything better or improve your returns. What you have to be cognizant of is that styles on their own, singular styles, don't necessarily always generate alpha. So the question is, what is the best style to invest in? That's based on one's relative risk aversion. If you are a risk averse person, you probably would tend more towards quality and low volatility. If you're a more risk-loving person, you probably would look at a combination of value and momentum. The real question is, who knows? No one knows where styles are going to go. So what can we do? We can't just end it here. The question is, how can we use styles to actually improve performance in portfolios? And that's actually the subject of what we're talking about today. So how can we use styles? Style-based investing. So the point of view that 27.4 holds, right, is that we can use style for the following things. You can use it for evaluation. You can use it obviously for diversification and alpha generation. So when we say evaluation, the tools that we use are returns-based style analysis and holding-based style analysis. Diversification, you can do something called the style completion portfolio, which we'll take you through. And alpha generation is how can we optimally combine styles to actually have a really solid portfolio that has a higher probability of beating the market than taking on a singular style. So let's get started. Evaluation. So this is output of the models that we use. This is a returns-based style analysis on this side and a holdings-based style analysis. Even though they look quite different, they actually tell you very similar things. So the first thing is what you can do is you can say, we've run this on a dummy manager, a long-standing manager in South Africa, a pure equity manager who has quite a nice long history of returns. What the RBSA does, it says, take all the style returns that we generate internally through our research and find or try decompose that manager's return based on their style. And that's using linear optimization or regression. And what you can see here is that this manager is mainly predominantly growth and value. We also run it on the cap SWIX. So that's normally the regular benchmark for most equity managers in South Africa. And you can see relative to the cap SWIX, they have a overweight in growth and overweight in value, a little bit of low beta. And where they're lacking is they don't have a quality side to them. But in general, they are quite benchmark cognizant. But you could see definitely a value overweight, a growth overweight, and a slight low beta overweight, but no quality. That's on pure returns. Then another method that one can use, you can try decompose a manager's return or a manager's style based on their holdings. So what that would involve is looking at each one of their holdings or taking all the shares in the JSE and defining what style is that share? What style bucket do they fit best into? And we do that by ranking shares. So if you have, say, 120 shares that are actually available to most managers that people do invest in, what are each one of those shares in terms of each one of these styles and their rank? And using that, what we can do is we can say, okay, based on the number of shares they have, that gives the share selection, which is the red pentagon, right? Weighting would be the green one. So that actually looks at the weighting that they have in each one of those shares and in terms of those shares and their style. And then we compare that to the cap SWIX also. So even though they look very different, you can see that this company has a high number of growth shares, but they weight more to value shares. And they do that more so than the overall cap SWIX. So what we can confirm with this, normally these two analyses should talk to each other. And what they tell you is that we can confirm that this manager is a value manager with a bit of a growth bias. And it's confirmed because they weight the most to value shares. And they do have a weighting towards growth shares that's in excess of the cap SWIX. So that effectively is their active style. How can we use this? It's nice to know, but the question is, how can we actually use it? So what this figure tells you is it looks at the manager's style benchmark. And what that means is that if I look at the weights that I've defined, sorry, from the previous slide, and I actually say, okay, let's create a passive, fictitious investment in those styles, I can look at my dummy manager return, which is the red line. I can look at the cap SWIX, and I can also look at something called their style benchmark. How have they done relative to their style benchmark and the cap SWIX? And we actually can take a lot of information from this figure, even though it seems very similar, well, simple in its makeup. What this tells you is that if the dummy manager exceeds both of these, the style benchmark and the cap SWIX, so if the red line exceeds both the blue line and the black line, what that means is that this manager, not only are they investing in great styles, they're investing in better styles, so they should outperform the benchmark. What they're also doing is they are picking the best shares within each style bucket. So they're actually showing true shares or stock selection ability. That's what Sharpe actually referred to it as. If the blue line is greater than the black line, so only focusing on the blue and black line. If the blue line is greater than the black line, what that implies is that the manager is correctly picking the right styles that should result in it beating the benchmark. And you can see that divergence there. It means that at this point in time, they weighted towards better styles that have resulted in beating the benchmark. However, if the red line is under the blue line or on the blue line, what that means is that the majority of this manager's benefit that it brings to a portfolio or to you as an investment is actually captured by style. You would be able to replicate this manager just by using passive styles. So we use this to actually evaluate managers, where the best managers are the guys that achieve a red line above both. And if the blue line's above the black line, that means that they're doing well with style. And if everything's under the black line, you know that there's something materially wrong, i.e. they're picking the wrong styles and they're also not showing positive stock selection abilities. So looking at this manager and everything that we've garnered so far, what we wanted to show you is that we like quality right now. It seems to be a very solid performing style. We're also big in favor of momentum. But the problem with momentum, you always want to couple momentum with some form of risk mitigant. So we would weight towards low beta. So what we do is we would then probably create a completion portfolio. And what that means is over and above this manager. So if we held this manager in a portfolio, what we'd want to do is try and diversify more across styles. We don't want to be so heavily invested in growth and value, right? We like the fact that quality is in the benchmark, but we don't like the fact that the manager has no exposure to quality, and there's also no exposure to momentum. And we also want to increase the low beta because we believe that because momentum is actually naturally a high beta or a high risk strategy, what can we do? We can try bring back the impact of increasing the risk of the portfolio with momentum by increasing low beta. So what we did is we effectively created something called a completion portfolio that uses our passive styles. And this is what it looks like now. You can see now the blue line is a dummy and completion portfolio. So it's the dummy manager with the completion portfolio. What you can see is it's an underweight now relative to growth and value of both the market and the original manager position. There is a much higher weighting towards momentum. We've increased the quality weighting, and we've also marginally increased the low beta or maintained it, but obviously you could see now that this is a more diversified portfolio. So the question is, with this completion portfolio, it's nice to see this picture, but what does that do to returns? So obviously everything can be deduced from back testing. Now we do know that back testing is limited in the sense that it only looks at the historical, but what we can say from that is if you have better diversification across styles, it should result in better risk-adjusted return. So what would our manager's return or our portfolio's return be looking at the dummy manager and a completion portfolio? And the weights that we used, we said invest 70% in the dummy manager and 30% in the completion portfolio. So what you can see here is our combination portfolio here, which is the blue line. Over the period 2019 to April 2020, you could see that our blue line had smoothed out returns. The green line is just the pure completion portfolio. The cap swix is there. You can see that our managers outperform both in periods, but what you do get is a smoothing of returns here. And if we look over the full period, what you can see is that what the completion portfolio has done, it has resulted in the manager returns in the periods where the manager actually did underperform both the benchmark, well, just the benchmark. What you can see is that the smoothing impact has resulted in a better risk-adjusted return. And that's what the completion portfolio can offer you, because what you're doing is the benefit, if we can articulate that from a passive and active perspective, active managers literally generate alpha by taking on active share. But we're saying, no, it's not only active share relative to the benchmark, we're saying it's active style. So when you actually take style bets, so what typical asset management thinking would be in the equity space is, okay, if we want to reduce benchmark risk, let's just invest in the underlying benchmark, a pure beta play. But what we're saying is you don't need to invest in the pure benchmark. You can actually just invest across styles and achieve even better results than just anchoring it more towards the benchmark. What we're saying is diversify across styles. And that's what a completion portfolio can do. Now going on to the next step, this is alpha generation. So a completion portfolio largely looks at diversification benefits of going across style, limiting a manager's active style by investing in other styles to give it a more holistic, diversified or style diversified portfolio. But now a lot of our research also goes into what are the best styles and how well can you combine them. So what we use a three-tiered approach where we'd say, looking at combining styles based on share selection, how can you weight those shares in a portfolio that gives you the best exposure to the number of styles that you're looking at? And then also, how can we optimize styles together? So what is the best style combination using share selection and weighting? So what we've shown actually here is the 27-4 multi-factor portfolio. And what you can see, it's exactly the same manager. Over the period 2019 to April 2020, this 27-4 multi-factor manager, through periods, underperformed our dummy manager, but both did consistently outperform the benchmark. What one can see here also is that as you start elongating the period of evaluation, you should expect that by selecting the best styles, you do get decent outperformance or alpha, right? And that's what our back testing has proven. And that's why we are a very firm believer in the alpha generation of a multi-factor strategy. So the multi-factor strategy, we don't really go into depth in terms of how we actually do select the styles, but we use a combination of portfolio mathematics and machine learning, where you can potentially rotate in and out of styles, or you don't need to rotate in and out of styles. You could say which styles work best for you as a client or anything and such. So this is effectively what our multi-factor strategy looks like and how it has done in back tests. And looking at this, this tells you a very simple table that shows return and volatility over discrete periods. And what you can see here is that our multi-factor strategy uses a combination of these styles. So if you look at pure momentum, right, over 1 year, it was one of the worst performers, and so was our dummy manager. Not a great performer over the last 1 year. The benchmark did minus 24.5% over this period that we looked at. Quality was one of the best, and so was growth. Our multi-factor strategy got 18.8%. So it wasn't by any means the best, but it's a combination of these styles. Same with volatility, right? The highest volatility, interestingly, what we have found that when you take into account March and April, so February and March of this year, where we actually saw the massive drawdowns related to COVID-19, what you can see is that the best performers were low volatility. Low beta didn't do as well, but quality has done quite well through that time period. Quality did very well in terms of volatility. But as you start moving down, what you can see is that consistently the 27-4 multi-factor always outperforms our dummy manager and the benchmark, but it won't necessarily outperform all the single styles. However, when you give it a longer track record where you expect the styles to start coming through and have situations where you can select styles based on either your machine learning algorithm or rotates into the correct styles or find an optimal style blend that works for us, this is what happens. You can see that its volatility and return start outperforming dramatically. Also, what we like to show is, because discrete returns are nice to see, but you want to know what is the consistency. And when we say consistency here, this is a simple measure of saying how consistent were each of the styles, as well as the 27-4 multi-factor and our manager, in terms of actually beating the benchmark over rolling periods. So here you could see that consistency, the highest consistency amongst the styles was actually growth, which beat the benchmark 55.2% of the time. The multi-factor beat the benchmark 64.4% of the time. Another metric that we use is time-weighted consistency, because the problem with pure consistency is that it gives an equal weight to the longer dated outperformance periods, When time-weighted consistency, what it does is it upweights the more recent period and downweights historical periods. And you can see even on that basis, it actually improves growth. Low volatility has not been the best performer. Quality has also not been the best performer, but our multi-factor strategy comes out. So we're not saying that a multi-factor strategy is going to achieve 100% outperformance over the benchmark. That's impossible, specifically on the JSE, and anybody who promises that, it's impossible. But what we can guarantee is that based on history, we know that a multi-factor strategy that selects the best styles at a particular point in time and rotates in and out of the correct styles should have a higher probability of beating the benchmark. Now, let's talk about style performance in market states. This is an interesting thing. And what we wanted to show you was we did a very simple analysis. The simple analysis that we did was, if we look at the J403T, which is the overall benchmark that no one actually uses, but it's a nice proxy because it's what you measure beta on for most shares in the JSE. The J403, we've shown here scenarios where the J403 had significant upswings. So we looked at those significant upstates as well as significant downstates. So the significant upstate is based on, was this month's return higher than the standard deviation calculated over the last year? So if the return on the JSE was 10% in 1 month, but the standard deviation of returns was 20%, that wouldn't feature here. But if the return on the JSE in 1 month was 10% and the standard deviation was 6%, then that upswing means that it had a significantly positive month. The same with the downswing. So what we do is, if the downswing was minus 10% and the standard deviation was 6% over the previous rolling 12 months, then it would be a downstate. So that's how we define the up and down states. And what you can see, you'd expect. Momentum is very similar to the market because it naturally is a low beta strategy. It naturally has, it's naturally a high beta strategy, apologies, and it normally moves heavily with the market. Value, on the other hand, value's had a very torrid time in South Africa recently, so you can see it has just as bad downside risk and not as good upside risk. Quality, you could see that quality does protect somewhat from downside risk, but also has not had the best upside risk. Low vol does what it's expected to do. Low volatility, you'd expect that when the market drops dramatically, low vol drops less on average. But when the market goes up, it doesn't increase as much. Now, the big thing is, obviously one of our major talking points was, how have styles done recently and what are the styles that we feel are the best styles to invest in? So we actually show you two diagrams here. The first one is a factor weighted, where we actually invest. So if we are sorting shares based on momentum or winner shares, right? So winner and loser rather. What we would then do is say, okay, those winner shares, we assign so if we look at the top 30 winner shares on the JSE, we assign a weight to those shares based on their actual momentum score. And what that does is it actually increases the exposure. So what you could see here is the best two performing styles post the drawdown that was seen in February and March 2020 was momentum or winner and quality. Both of them have rebounded quite well. However, neither of them have actually reached levels. They didn't actually beat where their previous levels, so they both have still been quite badly hurt, but they were the best in terms of the rebound on a factor weighted basis. So when you actually weight shares based on their style. We also show here on a market cap weighted basis, what are the best performing shares, what best performing styles. And what you can see here is that quality and growth on a market cap weighted. So something to note, all of these portfolios have exactly the same shares, right? It's just that we've changed the weighting methodology. So how do you weight those shares? So this is based on market capitalization weighting. And what you can see here, there's a consistent message here that quality has done incredibly well post or amidst this COVID-19 craziness that we saw in the market. And not only that, the important thing is that the quality that we saw that actually really did well wasn't profitability-based quality. Remember, I told you that quality we define quality based on profitability measures as well as balance sheet strength measures. Funnily enough, the low debt to equity shares, right, on the JSE seem to do much better than the high ROE and high ROA shares. So we're finding that quality seems to have done incredibly well in dealing with the COVID-19 drawdown. The most other very interesting thing is that low volatility didn't do what it has done previously. So low volatility and low beta did not actually reduce drawdown impact during this COVID-19. So what we feel is that balance sheet strength, particularly in terms of the style balance sheet strength, and we always have been big fans of momentum, balance sheet strength in the form of quality and momentum are a very nice combination, and we believe they should carry on to do well over the course of the year, given the very unknown territory that we are in as we speak. So how can we add value? First thing that's important, evaluation. What we do is we can identify the current style of a portfolio or building block. So clients would come to us and say, what is the overall style themes in our current equity building block? And we do that obviously on a global and local basis. And then what we can do is we can also evaluate how well they're doing and show them in the next step, what styles are you missing? And would you like exposure to other styles? And we can obviously offer them the style completion on a passive basis. Then the next thing is alpha generation. What we can do is we can use the academically researched blending methods. So we use a multitude of blending methods as well as other techniques to obviously pick the right styles. And what we can do is we can provide an access point, well, a single access point to a multi-factor style portfolio that can offer diversification, but it probably would be more risky because we look at alpha generation. The important thing is that with these two, what we can offer is that you can get a portfolio that is more style cognizant. You're not taking as much style risk. It's incredibly low cost. And what it should do always is provide some form of superior nominal return and should definitely lower risk. And that is pretty much it for me.
All right. Well, thank you very much, Daniel. You've really made some very complex subject matter sound so simple and easy. So with that, we will go ahead and take some time out for questions. There's quite a few questions that has come through. So being cognizant of time, we just have to be aware that our responses have to be shorter. So we have one question here. A lot of the quants in the market have come to ask quite a few questions. So we'll take the first one, a question on the HBSA radar graphic and the difference between stock selection and weighting areas. Is the stock selection area map calculated on ranked style characteristics coupled with the assumption that each stock is equally weighted, that is just counting the stocks?
No, not at all. So what we would do typically, you would be able to define what so if I were to take the top 120 shares on the JSE and assign them a rank based on a particular style like momentum, right? What we then would do is scale the rank by the number of shares. So where the top momentum share has obviously a rank of 1, what one would do is you'd say that it has a weight of 1. But as you move lower down, so actually, sorry, the way that we scale them, so what we do is we try to ensure that the weight is defined by the style of the share, right? Or by the rank of the share. So we do a rank-based weighting. And then that rank-based weighting is then multiplied by the weight in the actual portfolio. And then what we do is normalize that to equal 1. And that's how we get a style of a portfolio based on the weights in each share. If you were to just count the number of growth shares that they have, right? Say within the top 30, that's how you say based on share selection. But weighting is completely different. It's definitely not equally weighted. We are cognizant both of the rank of the share as well as the weight in the particular portfolio.
All right, so hopefully that answers the question. I've got a next question is, given that one cannot identify the inflection points, how do you decide when to implement the completion portfolio and which one to implement?
So completion portfolio is not, the inflection point is mainly based on the alpha generator, which is the multifactor, because our completion portfolio is much more tailored for diversification. So you're not really looking for an inflection point there. What you're looking for is what is the style of the current benchmark that you're using look like? What styles are you more in favor of that you believe you're really missing? And we can obviously provide that analysis. And then what you do is you can weight towards styles that you're missing. So normally what single active managers will give you access to is normally they are single style followers. Even though they may have other weightings that they may be not aware of, what they are doing is they're giving you a single style because that's their style thesis. That's what they use, right? So you have a value manager, you could have a growth manager, you could have a quality manager, and that's typically what we see in South Africa. But what we do with a style completion portfolio, we could say there are other styles that are featured in the benchmark that you don't have access to. Let's remove the impact of active style and make you more style neutral with the completion portfolio. And naturally what that should do is give you better risk adjusted return. And we can do that in a number of ways. You could actually do a direct investment into our underlying passive style portfolios, or we could create a combination style portfolio, i.e. a multi-factor, that if someone is completely missing low beta and momentum, we could provide a momentum sorted portfolio that is actually weighted based on the inverse of beta. So you get exposure to both of those styles. But we don't look at an inflection point for style completion.
All right, fantastic. Another question here, in your classification of shares into style buckets, is this binomial? Example, a share is value or growth, or do you use a spectrum? Example, a share could have a 60-40 value growth score.
So what we would do is we could rank shares on singular styles first, right? And obviously so it is possible because you're only dealing with 100 shares, you could say a share could easily be a winner share and a value share and have low beta. It could have those qualities, right? But the thing that really defines it is looking at what is the rank of that share, the relative rank on the cross section. So if you have a cross section of shares and you rank them based on momentum, the top ranking share could be AGL, hypothetically. It is the top momentum share, but it only comes in at 22 in terms of low beta. So you still have this, it's all based on the cross section. We don't do a binary method of looking at that. We look at their relative to the entire universe at any point in time.
Okay. We've got a very interesting question here. Did the quality factor exceed your expectations when looking at the factors in the drawdown scenario? And why is it that quality is not consistently outperforming the benchmark or the completion portfolio over the period? So I think it's referring to one of those slides you had,
So the one thing that we're always cognizant of is that styles themselves are risky. There's no saving style. Momentum, we know, you could see it had the largest drawdown because it's naturally a high beta. So when the market drops, momentum gets hit very hard. But momentum does very well in periods of growth, and it also does very well, not in a market turn, but it does very well after a market turn, when people start picking up momentum and there's a herd mentality. Quality has surprised us completely because typically what we would expect is that low beta and low vol should have outperformed. They did in the previous financial crisis. They did incredibly well in 2008 and 9. That's when they did well. But the weird thing that we're noticing with quality, and this is the most interesting that our research is showing, is that quality through time, the main premium that you got from quality over the last decade was associated with the profitability side of quality, i.e. high ROA and high ROE shares gave most of the quality premium. What we found of late, when you have this relative risk aversion in South Africa or globally, quality based on leverage or balance sheet strength seems to be outperforming everything else. So it seems that the market is putting a premium on shares that are well positioned to take on the tide. They have strong enough balance sheets that they will be okay.
Which leads me to the next question, and it's one that we get all the time. And I think you've really touched on it now in the latter part of your last statement. Is what is the relationship between investor sentiment and style analysis?
Okay, so this is you're getting more into an intense debate of whether there's a risk-based explanation of style or a behavioral.
Yeah.
Well, behavioral. So some styles, the problem with a lot of styles is that you can't actually. So what Farmer and French did, the guys who I mentioned, what they did very well, they incorporated their styles into a multi-factor model, which they called the Farmer and French 3-factor model. And they did that very easily because what they said was that when you invest in value shares are shares that have been completely blixened by the market, right? And therefore a higher risk. It makes sense why. There's a risk-based explanation for that. There's also a very nice risk-based explanation for size when it was a significant style on the JSE. So smaller companies you would expect are more risky. Therefore, that's why they should achieve higher returns. When it comes to momentum, momentum is a psychological phenomenon where you have excess buying literally drives momentum in share prices. And you rely on that additional trajectory of excess buying. Now, the interesting thing about momentum is that if you hold it for too long, it reverses. Because what the market starts realizing is we've overbought this share. And that's why you get something called long-term reversal. So you have to be cognizant of both. What we try and look at is there's a very basic premise. I can't remember the exact paper. What is a style? How can you define something that's a style? Because there's billions of styles effectively in the market and what people have used through time and documented in literature. A style is something that has to consistently through time, even though it may wane and go up and down, does it provide a significant long-only premium and does it provide a long-short premium? I.e., if you take that style, there's a factor style and an anti-factor style. So with momentum, it's winner versus loser. With quality, it's quality versus junk. Does it provide a consistent premium through time? Now, what that leads to is people saying, hang on, is value still a style? It's a question. It potentially is still a style, but we don't use value as literally just using value as a single style. We are big into blending styles. So it is possible that you can have a quality portfolio that also looks at the underlying relative expense of each share based on earnings yield or PE ratios. And that's why we're very pro blending styles. And what you will see is that by blending styles, you probably should get better risk-adjusted returns through time. And that's how you can really identify premium.
Okay. That's quite a comprehensive answer. The crystal ball question. How do you determine the rotation between styles? How do you actually know when to rotate out of and into different styles?
So the techniques that we use, so the big problem is that you don't know how styles are going to perform. No one does. But machine learning can give you a little bit of insight into that. So we use a couple of techniques where we would make it a classification scenario where we would say, if based on certain factors or using certain historical factors, what is the probability of a style outperforming in a particular period or going forward? So that's how we convert it to a classification problem. We also use time series forecasting techniques where we'd use value at risk and deep neural nets, where you can actually forecast how styles will do on a time series basis, so not on a cross-sectional basis, but on a time series basis. And we also use that. Is it foolproof? 100% not. But it gives you something.
You know, the issue around South Africa versus the global markets and the limitations in the South African market. We've got a couple of questions and they all point to the same issue around the size of the market. And whether you can efficiently apply style-based analysis the same way you do in, for example, the US market to the domestic economy.
Yeah. So what I can tell you is you have to come up with different ways of actually proxying styles. So I can tell you now that if you just use market cap weighting, so you could select styles on exactly the same, select shares under a style, but normally what you'd have to do is use some form of weighting technique that gives you a more aggressive positioning towards the style. And that's the easiest way to do it. When you have a bourse of 5,000 tickers, it's much easier to define styles. But if you're literally dealing with 120 investable shares, you are significantly limited. So you have to come up with different ways of actually proxying a style. And that's why weighting can actually contribute much more to style identification than just share selection. And that's why we pay a lot of attention to that.
Okay, here's a very strong academic question. So what is your view of the possibility that within a few years of a style's statistical significance being documented by academics and then being adopted by industry, it soon fades, is arbitraged away? Value was a big winner in South Africa in the 90s when it was both novel and unpopular. Less so over the next 10 years and dismal in the past 10 years. This goes hand in hand with the propensity of asset managers to use or acknowledge value investing.
Correct. So this is Rowan William Short. You're speaking my language. I actually wrote a paper on, this is so in finance theory, this is called limits to arbitrage. So what limits to arbitrage basically means is that you have smart money in a market, right? And if a style is acknowledged by the whole market and used by the entire market, it can eventually be arbitraged away, i.e. there's no benefit to actually holding the style because people are just using the style. If everybody thinks that something's undervalued and start buying it, it will eventually hit its true value. So limits to arbitrage means that this is a reason why styles can persist and go on. So if there's a reason why you may be limited to arbitraging a style away, that's a question, and that's why maybe styles do persist. Is limits to arbitrage a reason why value has gone away? Possibly, but that's why we are very big proponents of style combinations. This is the big thing. That's where you can really generate. Single style investing, because the market is much more cognizant of single styles now, there is a much higher chance that if everybody's picking the same value shares, they're no longer going to be value shares. That's a problem. So what we do is, and that's why we are huge proponents of multi-factor investing, but it's a very interesting question.
Dan, I want to come to this issue around passive and active and costs and fees. And, in South Africa, we have sort of two camps that believe very strongly on passive and going for full passive equity building block. And then you have camps that only believe in active. There's a lot of questions relating to kind of core satellite type of building blocks and how style-based analysis can be used more from a hybrid perspective. So what is your view on going fully passive, fully active, or hybrid? And what, from how we construct portfolios from a 27/4 perspective, maybe you can also provide your input.
Okay, so everybody has a different view. I acknowledge that, and we're very cognizant of that. And there's so much literature that says the majority of asset managers, i.e. active managers, don't beat their benchmark. We also acknowledge that. That's very, very true, right? However, when one talks about the majority, if you are able in some shape or form to pick the minority that does outperform the benchmark, then that is reason enough to probably still utilize active managers. So it is important to note that we do believe there definitely is space for active managers. We believe there's space for pure beta, because sometimes what we do know is that you want to hug your benchmark because we are all benchmarked against a benchmark. There's a reason for that, pure beta type play. There's also a reason for style diversification, because what that does is allows you, instead of just hugging the benchmark, what you could do is actually get a better exposure to other styles that aren't captured in the benchmark and be more benchmark cognizant in terms of styles. So our approach and our feeling is that there is room for all of it. It's just a question of you have to be very, very circumspect about the managers you pick, the styles you pick, and how much pure core passive or pure beta play you include in your portfolio.
Okay. So on completion portfolios, we've got a question that is relating to whether, the focus is, what is the goal? Is the goal more on diversification across styles, or is it, to create biases or not? What would your view be?
So something that we've picked up, when doing this analysis, what we found is that in South Africa, the main split that you get, if you were to take all the South African managers that we've seen, there are themes, there are style themes that we see. You have growth managers, you have value managers, and you have quality managers. We don't have any managed volatility managers, right? Or low vol managers or low beta managers, and we don't have any momentum managers. So what we believe is that on completion of style, if you want to be more, if we believe that these are the styles available in the market, and our research proves that there are these styles that are available, what one can do is you can diversify across all those styles. So there's a huge diversification thing. Potentially diversifying across styles that aren't captured by the market could give alpha, right? But it's constantly that balancing act between, you want to be style diversified, but you don't want to deviate too much away from the benchmark. And that would be up to the client's level of risk and what proportion they actually want to allocate to a completion portfolio.
Okay.
Yeah.
Well, Dr. Page, we've come to the end of our session. We have received an overwhelming number of compliments on the presentation. We have also received a number of questions that, given our time constraints, we are unable to cover today. And we're hoping that those individuals can contact us outside of this webinar.
Yeah.
Dan, before I close off, is there anything else you wanted to say before I wrap up?
No, it's good. But thank you. Very good questions, guys. And I see a lot of people that I know, and it's wonderful. Thank you so much for joining in. People I really respect in industry. So thanks for joining in.
Okay. Well, great. Thank you, everyone. We hope that we have provided you with a fair amount of insight into the capability of our quantitative analysis team and the role that they can play in assisting retirement funds and financial advisors and other investors build more robust and efficient portfolios. We would be happy to engage you individually to learn more about your funds and provide you with the solutions to fill any gaps that we identify. Our webinar next month will focus on unlisted investments and will be hosted by 274's Head of Unlisted Investments, Rory Ord, who's also one of the leading practitioners in the industry in private equity and other unlisted investments. With the growing demand for unlisted exposure, we will look at the various investable opportunities in this space and how to implement them in a cost-effective and efficient way, particularly with a focus on institutional investment portfolios. So please do look out for that invitation, which should follow in the next few days. So with that being said, please do stay in touch, stay safe, stay healthy, send an email to info@274.com or visit 274.com to get in touch with us and to learn more about what we can do to help you. Thanks again for joining us today, and we look forward to our next engagement. Goodbye.
Bye, everyone.